Hey, what's up you guys? My name is Min and welcome back to my channel. So if you've been watching my videos, you've probably been saving a whole bunch of money, and that's great and all, but to be honest, saving money won't make you rich, but it helps. This is the lesson I started to learn when I turned 30. I was making a sweet six-figure income and I started to realize that this wasn't going to make me rich. So what I did was I went to my boss and I told him, you need to give me a raise because I need to make more money. And yeah, he gave me a raise and I realized that wasn't going to make me rich either. Well, like the title suggests, making a lot of money and even saving a lot of money isn't going to make you rich by itself. Let me explain. Let's say you were saving $1,000 a month or $12,000 a year, and let's just say you kept saving that amount of money for a long time. Do you know how long it's going to take you to get to $1 million? Well, let me do the math for you. It's going to take you 83 years before you become a millionaire. So most people are probably 20 when they start working, so if you did that for 80 years, you'd be 103 years old. You will probably be dead by the time you get $1 million that way. So you should probably just give up on trying to be a millionaire. I'm just kidding. Even if you found an extra $500 or $18,000 a year, it would still take you 55 years to get to $1 million. Now, I'm not saying you shouldn't save any money because having an emergency fund is important, and also you need money to make money. So how do you become rich and get to that $1 million faster? Well guys, you need to start investing your money. Stop saving it in your mattress and you need to put it in some kind of investment. Whether it's real estate, stocks, bonds, mutual funds, whatever it may be, you just need to make your money work for you. Now that may sound scary for some of you guys, but to be honest, if you guys have a 401k at your company, you've been investing this whole time. You just didn't know it. Go look at some of your quarterly statements from your retirement accounts, and you'll be pleasantly surprised how much money you've been making in there this whole time by doing nothing. I bet you've been making a killing and you didn't even know it. And if you don't have a 401k account, you need to keep watching this video. Let me show you one of my accounts so you can see what I mean. So this here is the Q4 2019 statement for one of my retirement accounts, and as you can see here at the beginning of October 1st, 2019, it had a beginning balance of about $43,000. These are the contributions that we made during that quarter, and then this is the employee match. And then of course, if you're using your company's 401k, they're gonna charge you a small fee. And you can see here, this account has grown $3,225 in that quarter, and it has an ending balance of $49,449. Now the nice thing about this ending balance is this becomes the new beginning balance in the next quarter. And so this whole amount is now invested, and so if the market continues at the rate it's continuing, looks like 7.2%, then we should be seeing a much larger number next quarter. So we just have to wait and see. Now one year I paid $400 for a CPA to look at my taxes because I was getting into real estate investing and I wanted to make sure all my taxes were done correctly. And he was looking at my income and he said, I really hope you're investing some of your money that you're making because you know that money doubles every 7 to 8 years. Now I looked at him funny and I said, what the hell are you talking about? And I'm a math major, so it didn't make any sense to me. And I did a little bit of digging and I figured out what he was saying. So let me explain it to you guys. So let's do a quick example of what that CPA said to me. So I'm gonna go ahead and put $1,000 here, and I'm gonna put no additional contributions here, and then put 8 years because he told me 8 years, this money's gonna double. And the estimated interest rate here, I'm gonna put 9% because the S&P 500 has been doing 8 to 10% on average, and I'm just gonna go with 9% here. And then the variance, I'm gonna leave 0 because we've already accounted for that in this 8 to 10. And then I'm gonna hit calculate. Well, I'll be damned, guys. It is almost $2,000 8 years later. So what the CPA was telling me was that if you invested your money, it has a tendency to double every 8 years. And that's because when you invest your money, you're gonna be getting gains off of that, and those gains will also earn money as time goes on. Now, if that doesn't make sense to you, let me show you one more thing, and I'll show you exactly how they got to this number. So I have here an Excel sheet that I just made up right now, and you can see here I'm using the same exact numbers. $1,000 initial balance, 9% average return works out to be $90 in that first year. And then if you put that $90 plus your $1,000, you get $1,090. Now the nice thing about this is in year 2, you start out with $1,090. And if you earn the same 9%, now all of a sudden you earn $98. And you can kind of see here as it kind of repeats itself all the way down, your balance at the beginning of year 8 is $1,828. And if it earns 9%, it's actually gonna make $164. And you can see the final balance after year 8 is $1,992.56, which is exactly the same as what this calculator gave us. And so what's happening here is basically it's taking all of your returns and it's reinvesting it into the stock market. And you can see here it's just growing over time as you're making money. And so as this number goes up more and more and more, the average percentage return will stay the same, but the average return will be higher, right? So let's just change this to $10,000. And you can see here it still doubles from 10,000 to almost 20,000, but you can see all your returns are a little bit higher. So you can do this for any number you want. Let's say you had $100,000 in there. Well, in 8 years, you're probably gonna have $200,000 in that account. So there's the secret, you guys. Money doubles every 7 to 8 years if you invest it. So you need to stop saving all of your money and start investing it now. You don't need a 5-year emergency fund. I don't even suggest you pay off your house early. Maybe make an additional payment to your mortgage, but don't put all of your money in your mortgage. There's no reason to pay off your house early. You're still young, you have a lot of working years left. Put that money into an investment account instead so that it can double. For me personally, I have about 3 to 6 months of emergency funds tucked away, and the rest I have in real estate, individual stocks, or Vanguard ETFs. Remember, you can always sell your funds or your stocks if you need to in the event of a big emergency and your emergency fund doesn't cover it. Now, you don't want to have to sell your funds because that means that money is not working for you anymore. And worse, if you pull it out at the wrong time, you could be pulling it out at the bottom of the market potentially. You don't want to take that risk. Now, one thing you probably didn't know about investing is if you leave that money in there 12 months or longer, and then you decide to pull it out, you only have to pay 15% capital gains tax on that. And if you're married and have a household income of less than $78,750, you actually pay 0% capital gains tax. That means that you pay no taxes on any of the gains that you made. That's pretty sweet, and that's how the rich pay so little taxes. So instead of saving $1,000 in your mattress every month, take that $1,000 and put it into an investment account. I suggest something like Robinhood or Vanguard. I personally use both, and I would probably prefer Vanguard if you're doing long-term investing, just because a lot of it is automated and you can set up automatic deposits. With Robinhood, you have to do a little bit of work because they don't have automatic investing yet, and you have to manually go and buy some funds every month. Now, one thing wrong with Vanguard is they do charge a small fee for managing those funds, and the fee is relatively small, so I wouldn't worry too much about that. And the important thing is that it's automated and you start investing today. Now, if we get this video to 500 likes, I will share with you my Vanguard portfolio so you guys can see exactly what I bought in there. Now, by putting $1,000 a month away, this is actually a method called dollar cost averaging, and it's actually really safe to do this because no one can time the market, and the worst thing you can do is dump a whole bunch of cash into the account and buy at the wrong time. So I suggest you do like $1,000 a month or $500 a month or whatever you can afford to invest. That way, if the market changes, you don't lose too much money at one time and freak out. So I'll give you an example. Let's say the fund you were gonna buy was $350 today, and then 1 month later it was $300. If you were to put in like $10,000 right off the bat and bought everything at $350, it would drop to $300 and you would lose a whole bunch of money. And you'll probably hate me and give me a thumbs down in this video. But if you put $1,000 a month, then let's say that second month it went to $300, well, your average cost basis is now $350 plus 300 divided by 2, which is $325. And so overall, you didn't lose that much money. So I suggest you put it in every month consistently and just invest that way instead. So you're probably wondering, if I put $1,000 a month in there, how long is it gonna take before I become a millionaire? Well, let me show you. So let's put $0 here for the initial investment, and we're gonna put $1,000 a month. Now, we don't know the length of time in years, that's what we're trying to figure out, but let's just say, instead of 83 years, let's just say it's 40 years. And just say, let's cut that in half and see if this actually comes out to $1 million. So let's run this again with the same numbers and hit calculate. And you can see here, your money has become $4 million by 40 years old. So that tells you that if you invested that $1,000 instead of saving it in your mattress, you would have $4 million in 40 years. And that's half the time it took if you were to just save it and not invest it. So what is the actual number to get to $1 million? Well, I already know the number, it's 25 years. So if you were to put $1,000 a month away and invested it, in 25 years time, you would have $1,016,410 or somewhere close to that. So you guys can see here, it cut the time down to almost 1/3. This is 25 years to get to $1 million by putting away $1,000 a month or $12,000 a year. So you can see the power of investing and the power of the stock market. Now, the stock market isn't guaranteed, and it may even go higher than this. We don't know. But historic averages have shown 8 to 10% on average for the S&P 500, and so this is a safe number to use and maybe even a safe number to assume. So guys, you can see the power of investing and not trying to save every single dime. And if you're paying a $500 car payment, just know that 25 years from now, that $500 car payment could have been $500,000. So just keep that in mind. Now, if you don't have a lot of extra money to invest, I suggest you check out my other video on 5 ways to spend less money. If your company has a 401k, you can have the same exact effect by putting away pre-tax dollars into that account. Some companies will even match your contribution and give you more money if you put money away for retirement. That's a no-brainer, and the math works the exact same way in those accounts. The only difference is you can't touch that money until 59 and a half, which gives it plenty of time to become $1 million. If you're interested in other tax savings accounts, you can check out my other video here to learn more about that. So guys, start investing some of that money that you have saved up, and also put money away for retirement in your 401k accounts. That way you have a personal retirement account that's worth millions when you're ready to retire, and also personal investment accounts that are putting all of your money to work. And who knows if Social Security is going to be around, so you need to make sure that you fund your own accounts to retire with. And if we happen to get Social Security, I'm just going to use that and buy a Porsche. Just kidding. Alright you guys, hopefully that video was helpful. If it was, don't forget to hit the like button and share it with one of your friends. And if you enjoy videos like this, don't forget to hit that subscribe button and hit the notification bell so you're aware when new videos are uploaded. And as always, have a nice day.